Hi everybody and welcome back to my channel. In the last video that I released last week, I had discussed about the principle of financial prudence, which says that you must try and increase your income streams. And a very important point there was how you can increase your dividend income. So last week we discussed about one such company, which was National Aluminium Company Limited. If you haven't watched this video, please do go to the description box below and watch that. This week we are going to talk about another very good company, which is ONGC, Oil and Natural Gas Corporation Limited. We all know about this company, and so without any further ado, let's get in talking about this particular company. So when we talk about the company, this company was established in the year 1956 and it is held by the Government of India through the Ministry of Petroleum. The company is engaged in the business of extraction of oil and natural gas. The company is actually the largest profit-making PSU of Government of India, and that is why it was granted the Maharatna status in 2010.
The shareholding pattern of the company shows that around 63% of the shares are with the promoter, which is the Government of India. Now, this percentage has reduced from 67% to 63% approximately. Now, what are the implications of this reduction? We will be talking about this in the later part of the video, so do watch this video till the end. Looking at the rest 37%, let us look at who are the other shareholders in this particular segment. So, Life Insurance Corporation of India is holding around 9.5%. The foreign portfolio investors are holding about 8.65%. Now, this also has a very major implication. Again, we'll be discussing this towards the end of this video. The Indian Oil Corporation is holding around 7.8%, and some mutual funds are holding about 4.72% in this particular company. The net worth of the company is around 2,18,000 crores, which is the highest among all the peers. The debt equity ratio of the company is around 0.50, which of course is higher than the peers, but considering that the company is the largest producer of oil in the particular industry, having a debt is inevitable, and it should not be considered a high percentage of debt. The debt is definitely at an optimum level. The return on capital employed is quite good in the last 3 years. It is within the range of 15 to 19%, and in the year ended March 2019 it was around 19%. Looking at the book value per share, it is also increasing in the last 4 years. Currently the book value per share is around 173 rupees. Looking at the price to book value ratio, again the ratio is less than 1, around 0.44, which is a very good ratio. Looking at the sales of the company in the past 3 years, the sales are on a constant increase. The sales year-on-year growth for the year ended March 2019 was at around 31%, and the net profit was at around 38%. Now, as we've already discussed, that the company is majorly into the production of crude oil and natural gas. So in March 2019, approximately 71% of the total revenue was from crude oil and around 17% was contributed by natural gas. Now, we look at some very important numbers. Looking at the earnings per share for the company, we see that for the year ended March 2019, it was around 24 rupees. The dividend payout stood at around 29%, which means that each of the shareholder got a dividend of around 6 rupees 80 paise. In the previous year also, the earnings per share was around 17 rupees. Dividend payout was at 38% of the total earning per share, and hence the dividend was around 6 rupees 60 paise. You can see in the given chart, the dividend per share is almost constant in the last 3 years. The dividend yield, considering the current market price, is at around 8%. Now this return should be considered good considering the other instruments that we are having in the current times. So 8% return on an investment in a company like ONGC is very good. Now, so let us see what are the factors that are playing in favor of the company. The first point is that none of the promoter shares have been pledged. That means the shares have not been utilized to raise any loan against them. Second point is that the company has low debt as compared to other companies in the industry, and given the kind of industry that ONGC is working into, it definitely has a very low debt. The third point is that it has a good and strong sales growth. We have seen that in the previous slide also, how the sales stood at around 31% year-on-year growth. The company definitely has a good return on capital employed, which means that in the previous 3 years it has had ROCE of around 18%, 15% and 19%. That means for every 100 rupees that was invested in the company was able to get a return of around 18 to 19 rupees, which definitely is a very good return. Now, the FIIs and the FPIs have increased their shareholding. Now, in one of the previous slides, we had discussed that how the shareholding pattern has around 8% of the shares with the FPIs. Now, if you go and look into the website of the company, you will find that in the last 3 quarters, this percentage has gradually increased, though there is only a marginal increase of about 3 to 4%, but it is a very good indicator considering that the foreign portfolio investors are also investing in the company. The cons for the company are something which is not just specific to the company but also to the entire industry as such. So volatility in the international crude oil prices is something which is going to impact all the companies within this particular segment. This is definitely owing to the current situation of COVID-19 and the consequent demand issues. I've already discussed about these in my previous videos. I will give the link of that particular video in the description box below. Please do go through it and understand why COVID-19 is going to have a major impact on the crude oil prices. The other point is that the government or the promoter of the company has sold around 3.47% of its stake in the company. We discussed this earlier also in the shareholding pattern, and now I will tell you how this is going to impact the price of the share. Because of the divestment strategy of the government, where the government is trying to sell off its investments to raise money, and this has led to the increase in supply of the shares of the company in the market. Considering that demand is almost at the same level and the supply has increased, the prices of the share has gone down, and it poses a good opportunity to start accumulating the shares, not just for dividend returns but also for long-term appreciation. Also, considering that the company is a Maharatna company and the largest profit-making PSU of the government also adds to its value.
I hope you found this video to be informative and useful. I would encourage you to undertake similar studies yourself also and try to increase the quality of the portfolio of investments that you have. If you found this video to be helpful, don't forget to like, share and comment. And don't forget to subscribe to my channel. Thanks for watching.